All right, going over how we ideally want to use resistance. Now, before diving into the actual slides, I want to go over this idea of resistance first. So, what is the idea of resistance? It is very important to understand that if you're just starting out, and this is the first time, for example, going through Spring World, first time going through the MMT in general, then don't put too much focus on resistance. As in, I see a lot of questions. Hey, what do we do with this resistance area? What do we do with that resistance area right there? And when you're just starting out, it is more beneficial to just focus on, okay, what kind of order flow do we have? What is candle sign saying right there? Then the idea of resistance comes to fruition when we actually take a few losses. And we're like, well, why did we take that loss? And that could have been avoided, for example, due to resistance. So the main idea is first focusing on order flow, candle signs, the basics essentially. And afterwards, if we do notice that we start taking losses and we start looking at the idea of why did those losses happen, then we can incorporate resistance. And that is very important. So resistance is there to gain more accuracy overall, but you don't need it at the start. You just need to understand the basics at the start. That's quite important. Then eventually, resistance will allow us to avoid unnecessary losses, like mentioned, and it will give us a lot more accuracy in trading as well. So how do we get that accuracy, and how do we then look at resistance in general? Well, that's where we go over the reminders first right here. Because what is resistance again? Resistance is unmitigated, opposing PD rays. So we've gone over this topic before in a resistance video. I believe it was Analyst Month or Execution Month, not too sure, in a Spring Enrollment. And resistance is, first of all, unmitigated. So that means we have not traded into that resistance area before, into that PD ray. And that means that, for example, a fair value gap that has already been traded into cannot be traded into again. The swing high that is left behind in a fair value gap, for example, yes, that's a new PD ray that we can trade back into and then continue lower alpha, for example. But we don't have a 50% level of a fair value gap. The full fill of a fair value gap, so the 100% level of a fair value gap, that's not resistance. That's not sensitive areas in a fair value gap. And that is extremely important, and it's a small detail that is extremely important to understand. Because if you do want to use resistance, you need to know what is an unmitigated opposing PD ray. Because if you don't know that, then the resistance areas are random, and we might as well just use support and resistance, which becomes very random. The accuracy is lost right there. So unmitigated again. We have not traded into that area before. That is important. As soon as we trade into a resistance area, the resistance area is essentially mitigated. Okay, opposing. What is opposing? Opposing is if we have a bullish trend, then all the premium arrays are opposing PD rays. And if we have a bearish trend, so we are continuing lower, premium arrays are holding, bearish order flow is holding, then the discount arrays, the unmitigated discount arrays, those are the opposing PD rays. And the PD rays, like we mentioned earlier on as well in a different video, they are swing points. So swing highs, swing lows, previous candle high, previous candle low. Although for resistance, I would take previous day high, previous day low, or previous candle high, previous candle low. A little bit with a grain of salt. It's not necessarily the biggest resistance in that sense. Then we also have, of course, fair value gaps. We have breaker blocks, order blocks, and mitigation blocks. And those are, of course, those fair value areas right there. So that is the PD rays. And that is then an unmitigated opposing PD ray. Now, when is resistance gone? As in, when is disrespected? When do we not need to worry about it at all anymore? That's when we have had a two-candle rejection, either a successful two-candle rejection or a failure of the two-candle rejection. Both will tell us that that resistance right there is not relevant anymore. And then what we leave behind in that resistance area, that is relevant. So let's quickly look at a chart example of this. One example is sitting right here on gold, where we have this 4-hour fair value gap sitting right there, and we tap into it one time right there, and we get a two-candle rejection. You always, regardless of the two-candle rejection holding or failing, you always are going to get some type of two-candle rejection off of a PD ray. If you don't get it at all, then okay, perfect. It's a sign that we are fully disrespecting it. Now, here we get a two-candle rejection of this fair value gap. As soon as we trade into that fair value gap, it's now mitigated. So this fair value gap is essentially gone as soon as we trade into it. But the thing that we leave behind, so the PD rate that we leave behind in that fair value gap, meaning that is this swing high right there, that is now still a premium array. So that's quite important to understand, because you don't have a 50% level. You don't have when it fills the full fair value gap right there, then we get a rejection. No, the rejection here towards the left is off of this area right there, not the fill of a fair value gap, things like that. That's very important to understand. And the rejection then eventually lower is off of this swing high. So we always need to focus on those unmitigated PD rates. Otherwise, we lose a lot of accuracy. So here we are actually rejecting off of this premium rate, which is the swing high towards the left right there. Now let's see if we can find a few more examples regarding this as well. For example, in the same exact example, if we come into this fair value gap, as soon as we come into it, it's now gone. It's now mitigated right there, and the token rejection happens. Okay, the full resistance is essentially gone. Now, crude oil right here is also an example where we had this daily fair value gap, which we might continue lower from. We sting into it right there, and as soon as we sting into it, that's the fair value gap gone. The fair value gap right there is not relevant anymore. So the other premium rates are now still valid, where we have this fair value area, which we are rejecting off of, and we have this swing high that was left behind in the fair value gap. Those are still relevant, since they are not mitigated yet. They are still unmitigated opposing PD rates right there. And that's important to understand. Now, these reminders are reminders because we've already gone over them in the past as well. But right here, I want to go over how we use resistance in context areas. So in context areas, there's two things. We either are having context and we have resistance on the same time frame, or on the lower time frame. So on the time frame below our overall context time frame. Then, if it's the same time frame, we want to wait for a 2-candle rejection failure in that unmitigated opposing PD ray. If it's on the lower time frame, we either want to enter before or after. So here we are on Australian dollar, US dollar, and we have this fair value area essentially that we can continue higher off of, which also creates this context area towards that high right there. Now, when you have this context area, you need to understand that once we have on the same time frame right here as our context area, so our context area is currently on the daily time frame, we also have a daily fair value gap going against us right there, coming back into the context area. Already tells us, of course, we want more confirmation, but we also want more confirmation in the form of we want this 2-candle rejection off of that fair value gap right there to actually fill. So here we get a first candle, does not reject. Second candle does actually reject after sweeping the previous candle high to then continue lower right there. Now it's important to understand, okay, what does the third candle right there do? And then afterwards, third candle trades back above the 2-candle rejection high right there. As early signs actually at that moment in time that we do have a failure of the 2-candle rejection right there. So here we are still sweeping that high, which is quite important to understand, of course. We're still sweeping that high, not running that high. And once we start to create new fair value gaps going higher right there, actually running the high as well, so becoming comfortable above that high, that's when the full 2-candle rejection right there actually filled. And that's important to understand because otherwise we might get caught up in a consolidation like this, where we are stuck essentially between two PD rays before we get the real move higher. So it gives us more accuracy in the form of how much confirmation do we want right there and when do we actually want to look to get involved. And ideally we want to look to get involved when the 2-candle rejection right there, right here, starts getting a run above the high right there. So if it's a daily, then on the 4-hour, on the 1-hour, above this high right there, we want to run that high. Fair value gaps overlapping with that high to then continue higher off of that. That means we are out of that consolidation and we can actually look to continue higher as well, where this turns into a fair value area. And there right there is on the same time frame. But what if it's on the lower time frame? So here we are on crude oil. We have this 4-hour fair value gap right there, which we can continue higher off of. We can look to target this context high right there. On the same time frame, we don't have a fair value gap going against us. So we don't have an opposing PDA inside that context on the same time frame as our context. So if we go into the lower time frame, we will of course encounter certain opposing PDAs, unmitigated opposing PDAs. For example, we have this 1-hour fair value gap sitting right there. So what do? Do we avoid this entry right there? Do we on the 1-hour right there just wait for a full 2 candle rejection failure. But if we do that, then we can potentially miss the whole trade ID right there. What do we actually do at this moment in time? Well, what we want to do right here is just go into our normal entry time frame. And when we have 4-hour context in this case, we can still go down time frames to find the resistance areas towards the left. And that's fine. But if we go into the 15-minute time frame right here, for example, and we look at 15-minute entries, then what we ideally want to have is we want to enter before or after reaching this resistance. Meaning, if we have an entry that, for example, is right there, then we are entering before we reach that resistance area right there. That's perfect because we still have a chance to go break even at this moment in time. And that's what it's all about at this moment in time. Or after. So here we have a sting into the resistance right there, which is still perfectly fine. We can have a rejection of that. And then afterwards we sting into a 15-minute value gap, which we might continue higher off of. Perfect. That's also perfectly fine because now we are entering after, but never enter in the resistance. And what I mean by that is at this moment in time right here, we have now reached a resistance. So if we now enter like this, then if we do get a bigger rejection and we might actually want to continue lower off this 1-hour resistance right there, then there's also no chance for us to go break even. So if we compare this entry and we put it to the side to this entry afterwards right there, and to this earlier entry that we might have had right there, for example, just for the example's sake, then the best entry happens either before or after reaching the resistance right there. And we're talking about, again, lower time frame regarding the 4-hour context that we have. Because the reason why we can still enter these trades is purely because the 4-hour context is following through. And the 4-hour context is stronger than the 1 hour. So we can still look to target these highs right there. And then why is the resistance even relevant? Is to get you more accuracy. And what I mean by that is, again, leads me back to the first point in this whole video. If you're just starting out, all these things here are not that relevant. But as soon as you start taking trades like these, where you enter right as we enter the resistance right there, and you don't have a chance to go break even, it immediately translates over to a loss like this, for example, then that's important to take a look at. And then it's potentially important to start incorporating resistance as well. So in both the before and the after right there, we have an earlier chance to go break even. We could argue that this is already a chance to go break even for both these trades. Whilst if we have a trade like this right here, now we are essentially stuck. We're trapped right there. We can't go break even early. Essentially, we're doomed. If this is going lower, then we also didn't have any chance to go break even. So we always want to have at least a chance to go break even. And the chances happen either before or after reaching the resistance, not as we reach the resistance to then enter the trade. Now, the best trade, I would argue, happens again afterwards, where here we now have this resistance, and on the time frame below, we start creating a fair value gap. Now we have overtaken this resistance as well, where we struggled, and here we get this fair value gap, and that fair value gap right there is a lot higher probability than this fair value gap even right there. So there's sort of three options. There's a before, there is an after as we touch into the resistance, or we could call it in the middle, because we are in the middle of still potentially respecting that resistance. So it's before, it's in the middle, and then fully after is once we fully disrespect it with a new fair value gap going higher right there above the resistance area. And then that right there is even higher probability to look for an entry, because now it doesn't have any resistance anymore, which is why it's free to run towards the target right there. So the sole purpose of the resistance in this case, and on the same time frame, if we first talk about the same time frame in the previous Australian dollar, US dollar example that we had. If it's on the same time frame as our context time frame, then we want more confirmation essentially. If it's on the lower time frame as our context time frame, then it's purely for more accuracy. So it's seeing, okay, we can reject off of that right there. We can go break even more strategically. So if we enter correctly, then we can go break even more strategically. Things like that. That's important. All right. So in context, same time frame, more confirmation, lower time frame right there, pure for more accuracy to go break even earlier. And That is ideally the goal. Now, this is all in context. So what do we do if we have resistance out of context and we are not actually in context currently? Well, this changes things a little bit, because if it's still the same time frame right there, then either we want to, again, enter before or after. So the exact same thing that we did in context with the lower time frame, enter before or after, because again, it gives us more accuracy right there. It gives us a better chance to go break even. And if we're out of context and we are creating a context, it gives us a better chance to actually create a fair run where we might be able to go break even. So same time frame, out of context, enter before or after we reach the resistance. Then right there on the higher time frame, so if we are reaching a higher time frame resistance and we are expecting, let's give you an example. If we have where we are expecting daily context, but we have weekly resistance, then we always want more confirmation, a lot more confirmation. So looking at crude oil right here, if we want to continue higher towards this high right there that we have obviously already reached, then we will run into those unmitigated opposing PD rays right there. Now reaching that unmitigated opposing PD ray in the form of that daily fair value gap right there, that's nothing to worry about, as in we might actually want to continue lower off of that. And if we do get that, that's perfectly fine. But the probabilities are not looked at as their resistance is there to potentially push price lower. No, it's just there to not get caught up in a bad trading ID. The same thing that we talked about on crude oil on the lower time frame with that same time frame example that we had sitting right here, for example, right there. Where if it's on the lower time frame, inside context, we still want to essentially wait right there. All right, so taking a look at crude oil right here, and again, like we mentioned, that out of context, same time frame is going to be the same as that in context, lower time frame. So the example that we had with this 4-hour fair value gap right here, and on the lower time frame, we had 1 hour resistance going against us. That's the same exact thing as entering before or after as we do with out of context, the same time frame. So here we, for example, expect daily context, and we have this daily resistance right there going against us. That daily resistance going against us is purely taken into account of, hey, where can we potentially stop and where can we potentially then create a daily fair value gap to continue higher off of. So that resistance is just, again, similar to the previous example that we had, is similar in the way of it gives us more accuracy. So where can we expect price to halt for a while? Where can we expect price to consolidate for a while? And then if we entered before, something like this right here, or we entered afterwards, that is perfectly fine. But entering as soon as we come into that resistance, again, that's not fine. Now, in both these examples, why can they be similar on the same time frame and the lower time frame? In context, lower time frame, out of context on the same time frame. Well, that's because they are both not part of order flow. Meaning, if we are having on the in context example that we had, where we create context right there, and this is our context overall where we expect higher price off of the fair value area, and on that same time frame, we have a fair value going against us right there, and that means there's a conflict of interest in order flow. Meaning, if order flow wants to continue higher, it can still continue higher off this order flow leg, but there's also a bearish order flow leg created right there. So that leads to overall more of a consolidation. Where here, the difference between that resistance and this resistance is not actually part of our current order flow anymore. As in, we're not expecting that fair value gap to hold. We're just using that for more accuracy's sake. So if we want to enter before or after it, but not during that rejection right there, that is very important. Now, let's say we did come into this context area right there, into that fair value gap. Can we then simply look for an entry like that? Yes, just like the example that we had on the 1 hour on the lower time frame right here, we can simply look to enter as well if we get, of course, a good rejection off of that, and we get a good confirmation right there, we can simply look for that entry right there. But again, very similar to this scenario, if we have that before entry, that mid entry, and that after entry, then the after entry and the before entry, I would argue, are the highest probability. Why is that? Because if we enter before, then we have the earliest chance to potentially go break even, because we are not expecting any resistance area until we reach that fair value, for example. Meaning that at this moment in time, whilst we are starting to continue higher, there's no real reason to retrace anymore. Now, middle right there, if we had something like this and it came back into the daily value gap like this to then potentially continue higher, that means that there still might be a continuation lower right there. So we're still in the middle of failing that full rejection. And afterwards, that is the highest probability as well, with alongside the before trade right there as well. Now this is again very similar to what we had. This is the same time frame. Now here on GBP US dollar, we have this daily fair value gap sitting right there, and also this lower daily value gap right there. And both these scenarios have resistance on the time frame above right there. So before we actually create those context areas, we have this fair value gap on the weekly, and we also have this fair value area right there on the weekly. So right here, whilst stinging into these resistance areas, that's when we create the context areas. So we first, and that's important to understand, right? Otherwise it's an in context thing. So here we first come into the resistance on the time frame above, and then we have the daily context right there that we can continue lower off of. In a scenario like this, we need to understand that yes, we can continue lower. And overall, we can still be bearish. That's not the problem. The thing is though, that this discount rate, these resistance areas are stronger than the premium rates that we are looking to trade off of. So it's very unlogical to expect just a sting into these fair value gaps to then already continue lower. That's extremely low probability for price action to actually do, and almost, I would argue, almost never really happens. If we have resistance on the time frame above us, we get some consolidation right there, then we can still look to continue lower as long as we have more confirmation. So more confirmation, again, going to refer to the more confirmation video right there. But that's important to understand. And afterwards, we have the same thing with this fair value area right here. We respect it, sting into it right there. Then we get a bigger rejection. That creates the bigger retracement right there. And that creates that we need more confirmation if we do still want to see lower prices as well. Very important to understand, because the opposing PD rate right there is actually stronger than the PD rate that we are looking to trade off of. An example of this is also on GBP Canadian dollar right here, where we have this daily fair value gap right here. And then we also have this daily fair value gap. And what is the difference? Why I did mention that this daily fair value gap right there trading lower off of that, that's quite interesting. But this daily fair value gap trading lower off that, yeah, that's something I would avoid at all costs essentially. And that's because of the same time frame and the time frame above resistance. Here we have resistance on the time frame above in the form of that weekly value gap. So that weekly value gap, we can also understand, could be the cause that we might consolidate, that we might stagnate a little bit, create a bearish weekly value gap right there to then continue lower off of that. So this weekly value gap is important resistance, because here on the daily right now, what do we see? We see that once we sting back into that context area right here, we get more of a consolidation. And this is where very ugly price action tends to happen. And yes, it still delivers. But that's not a delivery that you want to be part of. As in, if we are going to catch this move right here, then how many tries would it have taken? It could have been this right there. Could have been, that could have ended up being a loss. Could have been this right there. Could have ended up being, well, potentially break even, potentially a winner right there. Then could have been this right there, which could have potentially, depending on your stop loss, could have ended up being a loss. So you're going to take a lot of losses before you take the winner right there. And that's important to understand, because that's not high probability trading. That's not good trading. So scenarios like this are, in my opinion, never at the top of the interest list, because it's never going to be the same probability, same high probability as that we have in different scenarios. With, what is a different scenario? If we take a look at this earlier daily value gap, then why is this a good daily value gap? Well, here we do have a daily value gap right there. And this daily value gap could be the cause that we might want to continue higher right there, but it's on the same time frame. So it's almost like a fair battle where if this daily value gap wants to push higher, it's not going to have a significant push higher back into this value gap to then continue lower. No, either this is going to cause a big move higher, and if it is going to be a big move higher, we're most likely just simply going to continue higher. But if that isn't the case and we struggle to push higher and we do have this daily value gap to continue lower off of right there, then it's just going to be a continuation lower instead right there. So there's a difference between that resistance. And of course, lower time frame resistance in this case, unless it's in context, is never relevant out of context. So to sum it up, out of context, same time frame right there, very similar to lower time frame in context, enter before or after. Then out of context, higher time frame, more confirmation is very similar to in context, same time frame, wait for 2-candle rejection failure, also more confirmation. And when we have same time frame in context right there, more confirmation, lower time frame, we simply want to increase the accuracy. It's very important to understand as well, if this all does not make sense to you and you're like, well, Arjo, to me it sounds like you're talking a lot of gibberish, that's perfectly fine. Ignore it for now, completely ignore resistance, just take normal trades like you would, and then simply look after a while, hey, I've taken 10 trades, I've taken quite some losses, I've taken some break-evens, some winners. What is a certain pattern that I can notice if I do incorporate resistance and I do start to understand it a little bit better? Because then you'll also understand it in your own trades. Because I can tell you like this, but when you start seeing it in your own trading, that's the most beneficial part. So if you don't understand it, then I would advise go over it like that. All right, perfect. Thank you.